Hello, and thank you so much for joining us for another edition of Market Sense. I'm Heather Hedges with Fidelity. With the headlines changing day by day, sometimes hour by hour right now, there's still very little clarity right now on how or even when the situation in Iran might be resolved. And that uncertainty has now stretched into a fifth straight week of market losses. Having said that, though, on the other hand, we are heading into quarter one earnings season, and so far the disruptions don't seem to be hurting estimated earnings. So we're going to be talking about that today and talking about potential investor takeaways as well. And to do that, we are joined in person this time, as we are often, by Fidelity's Director of Global Macro, Jurrien Timmer. We're also excited today to welcome back a familiar face to Market Sense. You've seen him before here. This is portfolio manager Chris Lynn, who manages more than $100 billion over several Fidelity portfolios, including the Fidelity OTC Fund. And Chris, you're here today to talk to us about the next phase of AI in the AI build out and talking about what this evolving landscape might mean for investors. So wonderful to have both of you at the table with me in person. And Chris, welcome back to Market Sense.
Thanks so much for having me.
Great to be here. And, when Chris talks, I listen, and many other people as well. So
yes.
It's a real treat.
As do I. Absolutely, Jurrien. You've said that very well. So let's, before we start and dive into this AI discussion, set the table for a moment. Today is Tuesday, March 31st, the last day of quarter one. And, just quickly, Jurrien, we've got to talk about what's happening right now with the stock market. Markets are feeling tense, okay? It is a tense time for many investors, and we know that's because of the geopolitics and because geopolitical issues drive a lot of uncertainty, right? At the same time, though, as I mentioned at the top of the show, we're wrapping quarter one earnings right now, and earnings estimates look to be pretty positive here. Problem is the stock market doesn't seem to be buying that or have gotten that message. So I guess basically the question for you is, who's right here?
Well, I think they both are in a way. So the market is clearly under some stress. It's up today, but tomorrow it could be down again. But if you think about oil prices are above $100, I mean, that puts a strain on markets. And if the blockage in the Strait of Hormuz continues, it will accumulate in terms of putting strain on not just the U.S. economy, but the global economy. So when volatility rises, markets take a step back. And so this is fairly normal. The market as of yesterday was down 9.8%, which nobody likes, but actually in the grand scheme of history, a 10% decline happens every other year. So they happen quite frequently. And one might say 10% is not very much given the headlines, right? I mean, there's a lot of bad stuff going on.
In other words, it could be a lot worse.
And that's the segue into your question. Mm-hmm. And that is that valuation. So the PE ratio, right? So the price is the price. The value is what you get, right? The price is what you pay, value is what you get. And valuations, the PE ratio, are down almost 20%. So the PE is down twice as much as price. And the difference between those two is that earnings are not only very strong, but they're actually accelerating higher. Like every week I go through all my charts and indicators, and I really noticed that over the weekend. It's like, wow, the earnings estimates are flying, right? And at first I thought, okay, it's the energy sector, but the energy sector is about 3 or 4% of the market, and it's not enough to move the needle. So something is really happening in the fundamentals, whether it's AI or still the after effects of the One Big Beautiful Bill Act. But that resilience in earnings and in the economy is allowing the price decline to be very modest, and most of the hits are being taken on the valuation side, which ultimately I think will present an opportunity.
So it's a divergence, but there are opportunities here to be had. Speaking of opportunities, let's talk about AI now. And Chris, I'm so excited to get your take on some of the themes that, we are watching right now and that you and your team are watching. And we have been seeing this broader market dynamic shifting, a little bit quickly since the start of the conflict in Iran. For example, stocks down, bond yields experiencing some volatility, oil prices up. Have tech and AI gotten caught up in some of these broader market shifts? And what are you seeing as the big drivers right now for tech stocks?
Sure. Thanks for the question. So in the short term, the stocks have gotten caught up in it a little bit, yes. But I'll admit, I don't know what's going to happen in Iran. It's very complex and hard to predict. but it can still be important and we pay attention to it. Why? Because something like the Iran conflict has the potential to really increase the cost of capital. And that's bad for companies that are highly dependent on external capital.
Yeah.
Not to mention something like $150 oil is just not good for the economy. And so if the economy were to theoretically slow, that would be bad for the revenues of a lot of these companies that are spending so much on AI CapEx. But I wanted to transition, and one thing I did want to talk to is the Mag 7 or the Magnificent 7. This has been really interesting to me over the past 18 months or so. And this is because the Magnificent 7 has historically, kind of for the past 10 years, been the quote unquote unofficial cool kids club for the stock market. It's driven a ton of the returns, and they've been pretty correlated as a group overall too. Now, what's been interesting is over the past 18 months, the performance of the individual stocks have started to diverge quite a bit. So specifically, what were previously deemed as AI winners, some of them have now become AI challenged. And some of the prior AI losers have now become AI winners. On top of that, it's pretty interesting how the market has overall broadened away from the Mag 7 a little bit too. And historically, the only way you could really play AI was through some or all of the Mag 7. So think about it, like right after ChatGPT launched in late 2022, in 2023, the only way to play AI in the public markets was through compute, i.e. NVIDIA. And to some degree, Microsoft, who had the relationship with OpenAI. And then in 2024, bought into a little bit to a lot of the data center and the power stocks. And then 2025 was really turbocharging this, whereby the main beneficiaries became the memory stocks. And then in 2026, now we're just talking about space with the impending IPO of SpaceX.
So there are more ways to play AI now, is your point. And you mentioned, the market dynamics shifting a little bit too. And, even before the conflict in Iran had started, Yuri, you were talking about the market broadening and the mega cap tech stocks, taking a break a little bit and the rest of the market catching up a little bit. Where do things stand with that right now?
So, the broadening, when you have a very concentrated market, as we've had for a number of years now, is definitely a double-edged sword, because if the leadership broadens, and it broadens because the Mag 7 are going down in price, as they have recently have been doing, the market indices, as we know them, the Dow, the S&P, they go down, right? The top 10 stocks are 40% of the market cap. Mm-hmm. So it can be, broadening is generally a good thing. You want more stocks to participate, especially if you're an active manager. But if you're like a passive investor and you're just in an S&P ETF, you're not going to really see you're not going to reap the benefits of that if the index goes down. What we've seen earlier this year is the other side of that, which is a much more benign broadening, where the S&P 500 cap-weighted index, the Mag 7, just kind of sits around and does nothing, while more and more stocks are going up. And to give you an example, year to date, so the quarter ends today, and the market's up quite a bit today, but so through today, I think the Mag 7 is down 12% for the quarter. The S&P is down 5%, but the S&P equal-weighted index is flat. And that gives you a sense of like the jaws are closing in a relatively benign way. And my sense is, given the resilience in earnings, that once this episode passes, hopefully it happens soon, that we can go back to those dynamics where it's a bullish broadening, and that generally is a good thing. And, Chris is the expert, but if the AI dividends go downstream into the broader economy, then maybe that's part of that story.
Another thing I wanted to talk about, Chris, and you had touched on this too, how much cash these AI companies need, right? And they're spending massive amounts of money on infrastructure and data centers. And investors are asking, that's all well and good, but where's the impact? Are you actually making money off of this? In other words, innovation's cool, but, you got to be able to monetize it too a little bit, right? Show me the money. So what are you seeing? Are the returns there yet right now for AI?
Yeah, this is the most important question, because you only have the right to spend money if you're making a return on it. And the companies know that, and the investors know that. And so right now, the unit economics and the returns on capital are there, and they're really healthy. They might not necessarily be immediately obvious to people if you just look at a snapshot in time's financial statements. And so it might be helpful if I go through an example to elucidate this.
Okay.
So let's just say, for example, you are an AI company and you spend $100 today to train and develop an AI model. And then over the next year, you make $50 of net profit on that model. So 50% return on capital, very strong. I would invest in that company all day, every day.
I would too.
And if you were the executive of that company, you would say like, wow, let's go invest even more capital in that. Let's go train the next model. And so let's just say, for example, you decide to train your next model and that costs $500. Well, now it will look like you're wildly unprofitable because your $50 of net profit from the first model is completely dwarfed and masked by the $500 of you training the next model, even though the unit economics on that first model were actually very healthy. So the timing can really mask a lot of things and make things confusing. But at the end of the day, the question is very well taken. If you want to have the right to be able to spend, you've got to be able to make money.
And that's the $1 million or $1 billion question, I guess. $1 million, I'm dating myself here. No more $1 million questions in 2026. Jurriën, you are a market historian. Speaking of history here, you've done a lot of research in the past about market bubbles. So we have to ask the question about, are we in an AI bubble? We've been asking that question. We actually had Chris on last time we were talking about that too. And I know you feel that we are not in an AI bubble yet. But for investors who may be a little bit leery of that, what are some signs that we could watch for that might indicate when we are potentially headed towards a bubble?
So last year, as I tracked these market parallels, we couldn't help but notice some, I wouldn't say similarities, but a little bit of an echo of the internet bubble back in the late 90s. Netscape went public in 1996.
We thought about Netscape. That was deep in the brain, right?
ChatGPT was announced or launched in 2022. And when you line up those two moments, the markets have been very robust and there are some similarities. And, maybe a year ago, we all started to wonder, like, is this going to end up the same way? And then in the fall, some of the more questionable, the cats and dogs of the space really started to move. And then it became the question that everybody asked. And I remember on the show, we talked about that. I was doing a lot of media interviews and first question that everyone asked, this was like in October, I think.
Yep.
And then something I think good happened. And that is that investors like Chris and others started to ask the critical questions. Not that you weren't asking them before, but all of a sudden it was like, how much spending is too much spending?
Yeah.
Who are the winners and losers? Is it maybe a zero-sum game, right? And then we started to see some scrutiny enter the market. And we also got into the private lending software. I mean, that's a whole other conversation.
Yeah.
But I took that to heart because one thing I know from having lived through bubbles and studied bubbles is that during bubbles, nobody asks the hard question, right? Everyone is in.
Euphoria.
Everyone is in there. And the fact that the space is scrutinized like this, while valuations are quite reasonable, I think is a very good sign. And just to give you one more example, in 1998, when the internet bubble really took off, I think Cisco, which was kind of like the poster child of that era, went from a PE of 50 to a PE of like 215, right? Now the leaders are in the 30s or so.
Okay.
Totally different ball game. And I think that's very good. And just one final point, if we had gotten into this parabolic bubble last fall and we had the Iran headlines, we would not be down 10%. We would be down multiples of that because then you would have this air bubble that would pop. And fortunately, that did not happen.
So great to have your historical perspective, but also to hear from you that what happened last fall maybe just led some discipline to the market and helped to kind of weed out some of the winners and the losers. And I know you're both paying attention to that. But Chris, I know I wanted to talk to you about your perspective because you have this fantastic front row seat to history right now. I would argue, you're not just researching about these companies, you are actually traveling and meeting with these big tech companies all the time, and you get to see what they are working on. So I would just love to hear from you what the biggest trends you are seeing right now that are emerging.
Yep. So the most important trend that everybody's talking about right now is the AI agent. And so what is an AI agent? I just think about it as an AI that can take action on your behalf to do something for you. And so that's different from how people have historically been using AI kind of as a chatbot really as like an information database, i.e. like glorified search.
Yep.
But if you just compare and contrast something like, okay, find me a restaurant that is vegetarian friendly in Boston, that is a very different prompt or query from book me a table for 4 on graduation day and make sure it's vegetarian friendly at 7 p.m. If they can't do 7, find a time that's close to it, ideally with some outdoor space. Those are 2 very different things, with the latter being far more useful for you and doing a lot of tasks that you would have had to otherwise do yourself.
Far more complicated.
Much more. And let's just take kind of more, even like one step further, like book me a conference for my 100 biggest clients, send them all individual emails asking what dates they're available, and then pick the date that the most people can actually arrive on.
Wow.
And find me a conference center that can accommodate that number of people, and then find me some catering options. Again, that would be something that would take you a long time, but now the AI, because it can actually do things for you, has just expanded the scope of its possibilities and is just far more useful, and people will pay for that. What's also scary is also, well, not scary, but really fascinating, is how fast they are getting better.
Yeah.
So a year ago, these agents were totally unusable. And now, like, they're actually helping me in my life. I was actually just going to research and find a price and inventory lookup for a smoke detector at all the hardware stores within a 10-mile radius of me. And it did a great job with it, actually.
Did you get your smoke detector?
I did.
Good. I'm glad, because you have a family, so you have to safety first here. But yeah, it's crazy. You get. I guess what you're saying is it's a personal assistant. It's sort of like Rosie from the Jetsons, but the difference between traditional AI models and agents is they don't need that constant human supervision, right? They're designed to function independently, which frees us up to, use our brains for other things too, right?
Exactly.
So what do AI agents mean though for software stocks? Because that is something you just hit on, Yuri, and where we saw a lot of volatility this year. What's going on there?
So this is the question the market's actively asking right now. And so I think there are 2 perspectives. I think most of the software pessimists or the bears would probably say like, wow, this is highly disruptive. And the reason is because all of SaaS software today, or software as a service, is written with a human in the loop in mind.
Mm-hmm.
With AI agents, there is no more human in the loop. And so that is a fundamentally different way of attacking the problem. And the skeptics would say the legacy SaaS companies are not the people to bring us into this brave new world of AI agents. It's just going to be too hard of a lift for them to adapt. I think a lot of the software optimists or bulls would say, okay, the governance and risk controls on AI agents are so early, and since these agents can actually take action on your behalf, we've got to really clamp down and understand what they're able to do. And so all the bulls on AI agents are just too optimistic on how this is going to diffuse, and we didn't make sure that we can actually control and maintain and orchestrate these things, and therefore the diffusion of these agents is going to be slower than everybody thinks.
It's going to require a lot of government regulation, which might slow things down and allow software to still have a place as well.
Exactly. So therefore, software could be more durable than a lot of the market participants think right now.
Okay, but the bottom line about these AI agents is that it's just phenomenal what they can do. They are truly very proficient, Chris. So given that, we've got to talk about the question of AI and jobs, Yuri. And I'll ask you about this because, the question is, it's certainly helping workers, will they replace workers? And right now we know from surveys that employers fill out that employers are not yet directly laying people off because of AI, but it certainly is slowing hiring. So I'm curious what you think about whether you think that this could completely at some point, change how many jobs are out there and impact the job market, or whether you think people might actually be wrong about this and maybe there's a silver lining to it and it supercharges the economy.
It's a great question, and certainly there's a lot of talk about it. There was a somewhat infamous research report of maybe a month or 2 ago that painted a somewhat dystopian left tail.
What did you think of that report?
Picture. It was thought-provoking, and I think the intent of the report was to just be that. Like, it wasn't a prediction. It was just saying, what does a left tail look like in this AI world? My guess is that it wouldn't get to that point because there would be governance issues. The government probably would step in, or there'll be a voter revolt, So I'm sure there are some checks and balances along that way. But even in a small sense, I think there's some anecdotal evidence that when you look at the economy being very robust, we're in a strong mid-cycle expansion. The economy is running well above its potential growth rate. So the numbers are pretty good. We're kind of in a run-it-hot economy right now.
Yeah.
And you don't see the labor numbers participate in that. So we don't have wholesale layoffs or anything like that. But one would expect more jobs being filled in an economy that's this strong. It's all anecdotal. We don't really know. But one conclusion would be that employers are doing more with less. And that, in a way, is the hope of AI. I mean, it sounds terrible, but increasing productivity, which by definition means you do more and better with fewer inputs, is something that the economy needs as we all age and the labor force starts to grow more slowly.
And maybe we'll all be able to retire at 50. Thanks to AI, who knows? Final question for you, Chris. I know nobody has a crystal ball. None of us can see into the future. But if you do find one of these tech companies that has crystal balls, please let us know. But what is next? What's the next major frontier in AI right now for consumers and also that investors might want to be thinking about?
Sure. So I touched on agents, a big deal. Two other spaces that we're thinking about a lot. One is physical AI or robotics. And now I know that everybody's mind just went to the Terminator, which is not what I'm talking about. Robots really just mean any sort of, let's just say, non-biological life that can manipulate the environment. So things that can pick things up, move things, push things. But if we can come up with a way to not only manufacture, but just really teach robots in a scalable way, that's really interesting for what we can actually do from an industrial perspective.
Okay.
And then the second one is space and orbital data centers. People are probably hearing more and more about this because of SpaceX's potential impending IPO that's coming out. But right now, if you want to build a data center in the United States right now, it takes a lot of time, takes a lot of money, takes a lot of power, requires a lot of water, a lot of scarce resources, and it requires a lot of regulatory permits and stuff like that. If you could, in theory or in practice, launch a kilogram of mass into space at a very, very cheap cost, then why not take advantage of that power generator in the sky, the sun, and you can also spare a lot of the natural resources that are here on Earth as well. And so that's what some people are thinking about right now.
That's the next frontier. All right, Chris, we are out of time, but Jurrien, really quickly, we always like to end with you and what's on your mind. We call it Timur's Take. So what are you watching?
Probably the most important indicator right now is the price of oil, and not only the price of oil, but the price of oil relative to future prices of oil when you look at the curve, the oil curve.
Yep.
And right now, the front contract for oil is about $30 higher than, let's say, a contract trading a year from now. Yeah. And that tells you that, A, there's stress, right? There's the bottleneck in the Strait of Hormuz, but also the markets expect this to be resolved. And so that's number one indicator I'm tracking every day. And the other one, there's a metric on the number of ships passing through the Strait of Hormuz.
Yep.
And that number was 0 for the last 3 or 4 weeks.
Yep, you've been
last week it was 1.
Yep.
Now it's actually, yesterday went up to 2.
2. Okay.
And so
progress.
but like everything else is sort of a derivative of those two numbers, right?
I'll give you another number too. The price for a gallon of gas in my house, $4.09, and yesterday nationally hit $4 a gallon on average. But you want to hear what it is in Ireland, or Dublin specifically? So a city, $8 a gallon. So could be worse. Yes. In that department. All right, we got to leave it at that. Just a really fun discussion, guys. Really appreciate just thinking about some of these things with you, Chris, and hearing your perspective. And thank you to everybody out there for watching and listening and registering and sending us your questions when you registered. If you would like more insights from Fidelity portfolio managers just like Chris, we have a resource that we want to leave you with. You can bookmark this page for the latest articles and videos from thought leaders just like Chris. It's fidelity.com/PM Insights. PM, of course, being for portfolio manager. So on behalf of Jurrien Timur and Chris Lynn, I'm Heather Hedges. Thank you so much for making the time today. Hope to see you back here next week. You can catch us live every Tuesday at 2 Eastern on Fidelity.com, YouTube, LinkedIn, and wherever you get your podcasts.